All right, let's call out the tape immediately. The screens are flashing some pretty mixed signals this morning.
They really are.
We're looking at S&P 500 futures, the ES, hovering right around 6,818. That's up a very, very cautious 0.3%.
Cautious is the word.
It feels like the market is trying desperately to find its footing after that sharp 2% sell-off we saw yesterday. But the texture of this tape, it doesn't feel like a recovery rally.
No, not at all. It feels tense. Wait and see is one way to put it, but wait and worry might be more accurate.
So what's under the hood?
Well, this isn't just random noise. It's a collision of some massive macro forces. You've got the renewed global tariff rhetoric hitting the wires.
The Greenland tariff headline.
Exactly. That's spooking importers. And then you have what the institutional desks are all calling the Warsh Factor.
Right. Let's get right into that because it's dominating the chat rooms. Polymarket odds, I'm looking at them now. Kevin Warsh is at a 60% probability to lead the Fed.
60%. And that's a massive jump from where we were even 48 hours ago.
And this isn't just some small administrative detail.
No, I can't stress this enough. The big desks, the ones moving billions, they're starting to price in a genuine regime shift. You have to understand, for the past decade, we've lived in an era of liquidity-driven rallies.
The Fed put was always there.
It was the background radiation of the market, always. But Warsh, he represents a shift to a valuation-first reality. The Fed put is ending.
I want to pause on that. We hear Fed put thrown around on financial TV all the time.
Yeah.
For the listener, what are we actually saying is expiring here?
Great question. The Fed put is basically the market's psychological safety net. It's the belief that if stocks drop too much, say 15, 20%,
The Fed will step in.
the Fed steps in, cuts rates, prints money, something to save the day. It encourages risk-taking because your downside feels capped. But Kevin Warsh, he has a history of arguing the Fed shouldn't bail out asset bubbles.
He believes in sound money.
Exactly. So if he takes the chair, that safety net might just be gone.
So the market is waking up to the idea that bad news might just be, well, bad news.
Precisely. We're moving from a world where bad economic news is bullish because it means more stimulus to a world where it's just bearish because earnings fall and nobody is coming to save you.
Which is a terrifying thought for a market at these multiples.
Absolutely. We are moving from a liquidity tailwind to a potentially volatile reality check. And you can see that anxiety playing out in the pre-market movers.
Okay, let's unpack those before the bell. We have to start with Netflix, ticker NFLX, sliding 4% pre-market.
Yeah, this one is painful if you're holding calls.
But here's the thing that's weird to me. They had a technical beat. The numbers weren't objectively terrible.
No, they weren't. This is a classic sell the news event, and it really just underscores that valuation theme we were talking about.
Because at 22 times forward PE.
At 22x in this interest rate environment, good is not enough. The market is demanding perfection.
It's an expectations game. The bar was set at the ceiling.
Completely. The street is looking at their 2026 content spend, which is huge, and they're questioning growth in a saturated market. They're punishing Netflix for not being perfect.
A sign that investors are getting pickier.
In a liquidity-fueled bull market, a technical beat sends the stock up 5%. In this market, it sends it down 4%.
Okay, so on the complete opposite side of the spectrum, we have Anteris Technologies, ticker AVR. This thing is popping almost 25%.
Yeah, now this is fascinating. Usually a company announces a capital raise and the stock drops, right? Dilution.
Right, you're cutting the pizza into more slices. My slice gets smaller.
Exactly. But here, the stock is ripping higher. And the reason is who is buying the pizza? Medtronic is backing a $200 million capital raise for their heart valve trial.
That is a huge vote of confidence.
It's massive. It effectively de-risks the funding for the entire trial. The market is saying, okay, Medtronic did the due diligence for us. They believe in the science.
So for traders listening, what are the levels to watch?
The bull trigger is $8.45. If it breaks that, you could see a short squeeze extension.
And the downside, where does this fail?
$6.20. That's the gap fill. If the market decides later that $200 million is still too much dilution, price will retrace to fill that gap. But for now, momentum is bullish.
Speaking of momentum, let's talk GameStop. GME. High relative volume again this morning.
This one is pure insider conviction against a weak macro backdrop. The SEC filing just dropped. CEO Ryan Cohen bought another 500,000 shares.
Putting his money where his mouth is.
Precisely. In a shaky market, Insider buying is the ultimate signal. Executives sell for a million reasons. Taxes, divorce, whatever. They only buy for one.
They think it's going up.
They think it's going up. The bull target here is $34.80.
Right.
The failure level, the trapdoor, is $26.50.
Then we have tech sliding, biotech popping, memes fighting. Let's round it out with the safety trade. Johnson & Johnson, J&J.
Flat to slightly positive, and in this tape, flat is the new up.
The definitive defensive play.
It is. They reported Q4 consensus EPS of $2.49, a 22% year-over-year increase. If you're a PM rotating out of tech, J&J is where you park the cash.
It's a flight to safety.
A total flight to safety destination.
Okay, let's get into the technicals, the parameters for today. Starting with the S&P, the ES. It feels like we're stuck in a box.
We're in what you'd call a liquidity trap. I'm expecting a chop fest today. Just a meat grinder between 6,790 and 6,830.
So the market just moves up and down without really going anywhere, chewing up traders.
That's it. Algos are hunting liquidity on both sides. They'll push it up to trigger buys, then slam it down to trigger stops. It's designed to frustrate you.
So what's the line in the sand? When do we know we've broken out of the grinder?
For the bulls, it is 6,865. That was yesterday's breakdown point. We have to reclaim that by the London close. If we don't, the path of least resistance is lower.
And support.
6,780. That's your 50-day EMA and a high-volume node. If that breaks, we target 6,740 pretty fast.
And over to the NASDAQ, the NQ. This feels like the epicenter.
It is. Tech is under the microscope. Resistance is 23,150. That's the VWAP.
The benchmark institutions use.
Correct. But the support is critical. 22,850.
And if we lose 22,850...
You trigger a liquidity vacuum down to 22,600.
A vacuum.
Meaning there aren't many buyers standing in the way. Price can fall through that air pocket very, very quickly. And the context is these AI CapEx concerns surfacing. You have the Sell America crowd getting louder.
That brings us perfectly to the deep dive. This macro overlay, what we're calling the dollar yield divorce.
This is the most critical anomaly in the market right now. If you listen to nothing else, listen to this. The 10-year Treasury yield is spiking. We are at 4.31%, a 5-month high.
Which is usually a massive headwind for tech.
Correct. But here's the divorce. The dollar index, the DXY, is weakening. It's trading near 99.00.
Okay, pause there. That is completely counterintuitive. Normally, high yields attract capital, so yields up means dollar up. That's the rule.
That's the rule, and it's broken. It's because of the Sell America narrative.
Break that down. What does that mean?
International holders are dumping U.S. Treasuries. When you sell bonds, the price goes down, the yield goes up. That explains the yield spike. But here's the kicker.
They aren't keeping the cash in dollars.
Exactly. They are converting it to euros, to gold. They are repatriating the cash. So they're not just selling bonds. They are leaving the currency. It's a sovereign risk play.
And this is the trap for retail traders.
It is. Because a lot of people see a weak dollar and think, great, bullish for tech.
Because it makes our exports cheaper.
That's the classic thinking. But the reality is we are in what's called a bear steepening environment.
Okay, bear steepening. Plain English on that.
Sure. It's when long-term interest rates rise faster than short-term rates. It's called bear because it's usually bad for stocks. It means investors are demanding a much higher risk premium to hold U.S. debt long-term.
They want to be paid more to take the risk of holding U.S. paper.
Exactly. And here's why it crushes tech. The value of a tech company is based on earnings far in the future. To figure out what those earnings are worth today, you discount them back using the interest rate.
And if the rate is higher?
The future earnings are worth less today. It is pure math. So if yields are spiking because of fiscal worries, tech valuations crumble regardless of where the dollar is.
So the weak dollar isn't stimulus in this case. It's a symptom of capital flight.
That is the key. If the 10-year holds above 4.30%, tech stays in the freezer. Valuation compression is the enemy.
Okay, so given that backdrop, where is the money actually going?
Smart money is rotating into defensive growth. Specifically, healthcare and biotech.
The liquidity hideout.
That's what we're calling it. Investors are rotating out of industrials and tech because of tariff risk and rates. But healthcare, it's domestic. It's consistent. People get sick regardless of the tariff rate.
And the biotech space, it's idiosyncratic, right? Doesn't really care about the tenure.
Exactly. Cares about trial data. Medtronic is going to spend that $200 million regardless of what the Fed does. So the catalysts are decoupled from the broader market.
So the strategy is to look for stocks moving on their own news, not because of the S&P.
Decoupled catalysts are key.
Let's look at the calendars so people don't get chopped up. 8:30 a.m., we had housing starts.
A non-event. The market has bigger fish to fry.
10.7, AM construction spending.
Warning sign here. Do not chase the candle at 10,000. Algos use that data to hunt for liquidity. It's usually a trap.
So where's the real event?
1:00 p.m. Eastern, the 20-year bond auction.
Why is that the one to watch?
Not in this environment. Remember bear steepening. This is the test of demand. If demand for those bonds is weak, yields will have to rise to attract buyers.
And that will drag the 10-year up with it.
And that hits equities. We need a strong auction to calm the nerves. The morning session could just be noise until 1:00 p.m.
So stocks are just the passenger and bonds are driving the car.
The tail is wagging the dog. When you have a Sell America trade on, equities can't rally sustainably until that stabilizes.
I want to circle back to the Warsh Factor to close this out. You said it signals the end of the Fed put. That's a huge psychological shift.
It is. Most people trading today have never seen a market without that safety net. For a decade, bad news was good news because it meant rate cuts were coming.
The reflex was the economy slows, the Fed prints, stocks go up.
But if Warsh takes the chair, his philosophy is much more focused on sound money. He is not a fan of bailing out asset bubbles.
So we could be entering a period where bad news is actually bad news.
Exactly. A Warsh-led Fed might just let a correction happen to reset valuations. That changes the entire psychology of buying the dip.
You can't just blindly buy anymore.
You have to buy because the valuation makes sense. You have to do the homework.
So, bringing it all back to today, the bell is about to ring. What is the final word?
Just ask yourself this. If the Fed put is expiring just as the 10-year is breaking out, are you positioned for reality? Or are you still positioned for liquidity?
That is the question. Keep position sizes small today. Trade the levels, 6,865 on the upside, 6,780 on the downside, not the headlines.
And watch that 1:00 p.m. auction. That's the tell.
The bell rings in 5. Let's get to work.